Good morning and happy new year. I hope everyone's 2024 is off to a great start. I want to thank you all for joining us for the January edition of the CAPIS research briefing. My name is John Lance, and I'll be your host this morning for this morning's presentation. Today, we have the pleasure of having John Fagan and Brendan Walsh from Markets Policy Partners joining us again to hit on the topics ranging from the Fed and the balance between inflation, growth, and market pricing, as well as China and a few other items. In addition to sharing their perspectives, Brendan and John will be taking questions at the conclusion of their presentation. Please use the Q&A icon at the bottom of your screen to enter questions. And then finally, before I turn it over to the guys, if you're interested in their services, I encourage you to reach out to Markets Policy Partners or your CAPIS coverage after this call to get more information about their research offerings. And with that, we proudly present to you Brendan Walsh and John Fagan from Markets Policy Partners.
John, thank you very much for the introduction. It's great to be here. As always, we enjoy doing these and look forward to questions. We'll start out with our basic view. Coming into the end of 2023, the markets were expressing really deep conviction. Conviction in the U.S. Soft landing story for the economy, conviction in relatively early and aggressive rate cuts by the Federal Reserve and other global central banks. There was a sense that, if not priced for perfection, certainly markets were priced for very high conviction on these positive outcomes. Our view for 2024 is that, we'll swing to a lower conviction equilibrium, essentially. That doesn't mean that the consensus of, the Fed beginning to ease this year and a soft landing is wrong. It's just that as we progress into 2024, the risks and the issues with and the lower conviction and some of the slippage, particularly in the between the Fed's what we expect the Fed to do and where futures are priced, will create essentially what we're kind of calling a post-holiday bout of indigestion for financial markets. We're seeing a little bit of that coming through in the price action here in January. You see this meandering, somewhat directionless, a little bit of a give back on the extended trends that were going into the end of the year, which was very bullish on treasuries and the enormous run up in stocks led by tech, but broadening out into other sectors as well. And we're seeing again sort of taking down the holiday decorations, a little bit of post-holiday indigestion, and pick your own metaphor on that front. We don't think that the Fed is going to be aligned with where futures markets are. I think first and foremost, our big call for the year is that the Fed isn't going to be higher for longer, but they're going to be trying to fight the markets and push them off of this relatively high conviction of a start in March. We've seen the beginnings of that, and the implied odds for a March start to the easing cycle going down to 60%. It was considerably higher before, and that is part of it's the Fed messaging, but a lot of it is just the data validating it. We've just seen pretty resilient, solid data in the U.S. and retail sales numbers provided that the last non-farm payrolls, and that is beginning to help the Fed's message get through to financial markets that they're not going to be in a big hurry to get into easing mode. The ECB, I think, has actually been more clear in their discussion. They've talked a lot more about sort of this calendar-based guidance. Listening to ECB, I don't think Fed officials have been all that specific about the timeline and the time frame, but we heard President Lagarde of the ECB earlier this week really talking about we're not going to have enough data to know that we are where we want to be on inflation until the end of the spring, and that kind of calendar-based guidance, I think, is what we expect the Fed to migrate to, something like that over the coming weeks. As the Fed tries to communicate more clearly with the markets and push that expectation for the start of rate cuts a little bit further back. Just if if not just to keep everybody on their toes and keep financial conditions from loosening any further than they are. They obviously loosened quite a bit through the end of the year. And the Fed has reason, to be encouraged, obviously, in the way that inflation is going. And Brendan can talk a little bit more about the inflation data and the way we're seeing it. But, they've got to make policy looking through out the next couple of quarters rather than in the rearview mirror. And, we'll talk a little bit more about the geopolitical situation. But, when you look at the tangled supply chains around the Red Sea and redirection of shipping, and how long is this going to be a problem? The global risks around Taiwan, are not necessarily acute. We don't expect, a worst case scenario here, but, a ratcheting up of pressure and the, metastasizing conflicts in the Middle East. I mean, just the news this week that Pakistan, Iran, I mean, we think that geopolitical upheaval is stagflationary. And we think that the Fed is going to have to be cognizant of it. And it's not the kind of risk that you cut rates into, right? It's more of a, something that will keep the Fed on hold longer, all else being equal. So it's a bit of a muddle, and we think that the first half of the year is going to feature this, increased indecision in markets, reflecting higher uncertainty, and higher uncertainty with a skew not toward a hard landing, but of a reacceleration or stickiness of inflation, and pushing those expected rate cuts both for the Fed and other major central banks later into the year. Again, not a catastrophe for risk assets, but a sort of a choppy sideways mess at the beginning of the year is what we're expecting. In terms of the inflation numbers, obviously we're getting.
Before that, maybe I'll just address the on the Fed, the size of the balance sheet. So the Fed has been in runoff mode. But recently, if you listen to any of the couple of the Fed governors who actually worked at the New York Fed and understand the kind of the front end and liquidity in financial markets, they have kind of brought up that it probably is time to slow that. And so much of this just has to do with all the stuff that the Fed owns, and it's very much in the front end. So it's running off very quickly. I think maybe a lot quicker than financial markets realize. And they realize that, kind of coming in the first half of the year, that could create some problems in liquidity funding going forward. So we do think that the Fed will slow the pace of the runoff, and that they really do want to shrink it back to kind of normal sizes, but they also don't want to blow up the front of the market. So we think they'll kind of find a happy medium on that front. And then on the inflation front, I think the producer price index for December was kind of a very indicative example of what the Fed kind of has now to face. The PPI, which so much of that is goods, we've been in outright deflation now for over 6 months, and that's entirely because of the supply chain constraints that were caused by the pandemic. That's all loosened up. Things are normalizing. The price of goods. And the PPI is really plummeted, and that has been seeping through to the CPI. But now you have to go around Africa, which is 35-40% longer to ship your goods, and that clearly costs money and seeps back into the producer prices, and then in the future the consumer prices. So much of what the normalization in our inflation has been on the goods side. And now you, as the Fed, have to factor in geopolitics into your inflation expectations. At a minimum, you can't expect the same drag deflationary forces going forward from goods deflation.
Yeah, and it is, despite the fact that the market really took Powell's at the last meeting, his commentary in a very dovish way. We think that still the Fed is animated by this idea that really comes from the Volcker era, which is the lesson from Volcker isn't necessarily how tight you have to be for how long, but it's, don't loosen too soon. Premature, mission accomplished declarations are not a central banker's friend. And so we think that the Fed is going to err on the side of holding rates steady. And that probably pushes that first rate cut into, I mean, maybe May, but we're thinking June. And that's aligned with the way that the European Central Bank is talking about the kind of data that they need to see, and the timeline that they want to keep rates extended at this higher level to wring inflation out of the system, and also just get a read on how the supply chain snarls around the Red Sea are feeding through to prices. It's going to take a couple of months to do that at least. So so we think it pushes it back.
Fed President Bostic reiterated that today, saying you don't want to cut and then have to raise again. And for the last couple of years, he's been a very good leading indicator. He kind of turned dovish before people did. And now he's kind of moderating that, saying, let's not get ahead of ourselves in terms of the rate cuts. We'll do it when it's time, but we want to be sure that it is time, because we don't want to have that mistake that Volcker taught us.
Yeah, it's a really good point, Brendan. He's been a really good bellwether, and has emerged as not among necessarily the big three, but among the other.
They tend to get to where he is.
Yeah, he's definitely been prescient in his outlook. So yeah, among these we've mentioned obviously geopolitics, and in that China, as I said, we're not expecting some sort of worst case scenario. We saw the election and how it came out, not obviously in line with what China would have wanted, but we don't think that is the beginning of a conflict in the Taiwan Straits or some sort of invasion. We think that China will continue to tighten the screws on Taiwan, and the aggressive posture of the military maneuvers around the island, and so it's not it's dialing up the pressure. It's another stressor on supply chains, another stressor, and something to focus minds from U.S. business leaders to make sure that they are managing their risks in China. This is a big theme, and certainly is potentially implicated in the U.S. presidential and general election cycle. We'll talk a little more about that in just a minute. But suffice to say on China, I don't know, this is our 5th straight year of being bearish on China.
Yeah.
So sell the rally has been our rallying cry when it comes to China. Any upside spurred by expectations of the Beijing doubling down on stimulus. We've seen some of these, but boy, the rallies that are induced by some of these announcements have been blink and you miss it. The credibility that Beijing has lost in terms of its bona fides as a effective stimulator of its own economy over the past few years have rendered these announcements pretty toothless in terms of the market reaction. And every time we always see the commentary, after enormous underperformance last year, it's time to wade back into China and pick the bottom here. We just wouldn't do that. There always seems to be something, whether it's a lousy growth number, whether it's the shadow bank collapse, Zhongzi, that was being liquidated. Usually you don't see Beijing being so inconsistent. Usually these guys get some sort of lengthy runway to wind things up. But that's another big problem that is has bedeviled the China investor, that headline risk that hits again and again.
You're 100% right about the inconsistencies, because from a policy standpoint, they might loosen the screws on some sector, but then 6 months later a CEO misspeaks and then his company gets taken down. So that's just the reality of investing in China now.
Xi Jinping, clearly President Xi, just doesn't care about the stock market. Obviously has a very different posture toward the private sector, and it's than a lot of investors had expected. And I think the Chinese leadership makes the bearish China case better than we ever could.
Yeah.
It's essentially,
they're not hiding it.
Yeah, I mean, U.S. companies and investors whistled past the graveyard for a really long time on the idea, on the fact that Chinese companies have no enforceable property rights in their own home market, except what the Chinese Communist Party decides to grant them on any given day. And the idea was, well, they wouldn't strangle the golden goose I think that we've seen, now like a whole flock of golden geese chopped to pieces by this current by this current administration's posture. So suffice to say, we don't think that China has a Lehman moment. We think it's more ice than fire. They have enough wherewithal and fiscal firepower left to be able to forestall a worst case scenario, but it's just they're running faster to stand still, and the stimulus just is trying to, at this point, not reaccelerate the economy, to try to keep four wheels out of the ditch. So we're not positive on China. We think that the Chinese, we saw this earlier this week when the economic data for China came out for December, looking soft and squishy and broadly disappointing. That punched oil prices right in the gut. But we think that oil is got this push-pull dynamic, very much like our view on 10-year Treasury yields, our view on equities, global equities and U.S. equities over the coming quarter or two. Here is a sideways, basically a sideways cha-cha. The oil prices, the uplift from geopolitical risk, and the kinds of demand that come from metastasizing conflicts, supply risks around some of these areas, offset by poor demand from China. We think that the U.S. economy is maybe in a mildly slowing trend. We don't think it's going to reaccelerate, and so the odds are that that demand is slightly on a downtrend through globally. We don't think Europe is going to be a big growth story this year. So the demand picture is a little bit weak to the soft side, but geopolitics and OPEC obviously pulling in the other direction. We don't think OPEC is going to give up the ghost here. We think that they're going to keep trying to have relatively elevated prices, but not induce a super spike. Let's see. Within this dynamic, as we sort of go through the sort of sloppy first half of 2024, markets struggling for direction, lower conviction, lots of guessing games about when that first rate cut is really going to come through. We think that over the summer, the Fed and global central banks do begin to deliver on rate cuts. They begin to meet the market where we've seen, and just in time for the election in the U.S. to begin to be a driver of markets. Looking back at 2020, it was kind of sometime midsummer when getting close enough to the election where it's in the investable horizon, the polls begin to kind of mean something around then, and it's you begin to get those tradable dynamics of one potential policy versus the other, and we think it's going to be a very it's going to be obviously a very nasty campaign. It's not going to be our finest hour as a nation. I think all sides maybe can agree on that, and not too many other things we can necessarily agree on at this point. But it is going into this dynamic, we think it's one of these climb the wall of worry type dynamics for stocks, which meandered through the beginning of the year. And obviously the sort of tantalizing in this case, when we look at the economic policies of our presumptive candidates, Trump versus Biden, I think the Biden administration second term isn't going to necessarily be they've done all the sort of fiscal firepower and so forth. It's going to be very much geopolitics to the fore. And we can talk a little bit about, we don't think that they're going to a second Biden term would radically change the posture toward China, except we think that there's a chance that they would put the Trump tariffs on the table for some sort of wheeling and dealing. We don't get any sense from the Biden administration that they see those Trump tariffs as anything but bargaining chips. They don't really think they're well structured. They've been obviously focused a lot more on the tech side, the national security stuff. That we think is just going to continue to tighten, and the national security community is completely aligned, and it's very bipartisan down here on that front. But there's a possibility a second Biden term could feature a little bit more wheeling and dealing, try to put some carrots on the table, and what would those carrots be? It would probably be the Trump tariffs. So watch that space if we do get a second Biden term. And we're going to talk a little bit about, some of these out of the money options maybe. But in base case, our base case is that Biden does win a second term in a messy election, but the Democrats lose the Senate and recapture the House. That actually, to our mind, is a perfectly acceptable and quite bullish actually outcome for the markets, because the Biden administration isn't particularly aggressive in its agenda in terms of raising taxes or something like that. But at the same time,
And he already really passed all of his agenda, so there's not a lot of things to fight for.
Yeah, it's going to be, I think it's going to be a lot more like software stuff, Unity trying to get, trying to do legislative stuff on elections and women's rights and so on and so forth, focus on geopolitics. And we'll talk a little bit, we'll leave a possible Biden second term scenario for the end to discuss when we do a little blue sky thinking. But in terms of former President Trump, there's certainly right now he's the national polls have him maybe slightly ahead, maybe within the margin of error in a lot of those polls. Don't mean a whole lot right now. The excitement around Nikki Haley obviously could give her a path to the nomination, but it's really just so hard for her. She's gaining in New Hampshire, but even if she wins New Hampshire, she's got to go to her home state and probably get trounced by Trump. And then where does she go from there? So we think that the nominee we think it's going to be former President Trump, and we think that that DeSantis probably, I don't know. Yeah, I don't know if he makes it through New Hampshire, but it's kind of all over. But there really doesn't seem to be a path for him after his decent but not totally encouraging Iowa showing. So it ends up being Trump, and we think that the markets are going to have a we're going to be focused on where the economic rubber meets the road with a second Trump term, and we can sort of leave aside a lot of the the crazier pronouncements about what it might mean, but and really focus on the economic ramifications. This guy is a reflationist, right? He's a debt guy. He's not a fiscal conservative. This was a very expansionary. His first term was very expansionary. Nikki Haley will tell you all about that. And he is already talking about how interest rates are too high. And this is a very appropriate and perhaps even fitting economic policy program for like 2016, 2017 at the outset of his presidency, when we were kind of mired in secular stagnation. But in the current environment where we've got inflation concerns are still in the picture, and the Federal Reserve is still going to be watching over its shoulder to make sure that inflation doesn't come back. It's the question that we have in our minds is the bond market going to be okay with in the summer, President Trump leading, let's say he's leading in the polls, and he's talking about replacing Jay Powell with someone that will slash interest rates, and he's going to slash corporate taxes. And put that in another context, the market would love it. Put it in this context, and then you start to have that bond volatility issue. We can all remember Liz Truss in the UK. Her economic program was deemed fiscally irresponsible by UK financial markets, and then her prime ministership didn't last longer than a Tesco head of lettuce. So you remember that ridiculous episode. But we're not saying that Truss equals Trump, but you can see and certainly draw some of the similarities and see how financial markets might have a problem digesting, an economic program that looks really consistent with what he did before, and the markets loved it. But context matters, and the context here is a much more inflationary and perhaps fragile bond market, treasury market than he remembers from when he was in office. As I said, our expected outcome is that Biden wins. Why does Biden win when he's got such high disapproval ratings? I think it's I don't want to say that the general election really kicks off in the summer, and people will begin to start will really start paying attention. And I think right now part of the dissatisfaction with Biden is that inflation, and there's not much he can do about it. But one of the problems, to go back to and we're trying to draw analogies, but one of the reasons that Hillary Clinton lost, she had a lot of partisan fervor behind her. But she hit the general, and there was the middle of the country just thought, oh my gosh, we have to deal with this, all of the baggage and all of the chaos and all of the, screaming back and forth and the investigations. And do we really have to do this? And I think that kept a lot of people from pulling the lever for her. And I think that, we're going to find ourselves in a political situation where, as a lot of the middle voting public reacquaints themselves with former President Trump, they'll say, gee, can I do I really want to see this on the news every day? It's going to be a chaotic time where he's juggling all of these court cases and so forth. The chances that he does get a felony conviction are certainly, maybe it's not a coin flip, maybe it's lower percentage than that, but it's certainly meaningful. And this is, so I used to be a lawyer, so I'm still a member of the New York State Bar. So I actually know enough to be dangerous on the legal front. But these things it's a trial, and they've got a tight timeline, but a lot of things can happen quickly in some of these instances. So it's going to be a knockdown, drag out campaign, but we think, very much like the last midterms, the more extreme candidates would tend to get through the Republican primaries and then struggle in the general. And we think that motif is essentially the same thing with former President Trump. One last thing, I mentioned the sort of this is a way out of the money option, but entitlement reform is something that is not going to be part of the campaign, right? The Biden administration isn't talking about it, and the Trump campaign has no interest in going there. Everybody knows that is the path. That's the way you begin to, try to solve the deficit problem. And there's really only, a second Biden term provides certainly not our base case, but provides an opportunity for an institutionalist, someone who can get bipartisan policies done in Washington, D.C., who is looking at their legacy and can perform potentially something that nobody else can do with his history, with his ability to work both sides of the aisle and to get something across the line. A second-term Biden presidency actually provides a small window and a small potential for entitlement reform in a meaningful way. No Republican president can do it because the Democrats would form an instant impenetrable wall and push against it. They would never be able to peel off any Democrats. If a Democratic president does it, it's like Nixon in China, right? Only someone as left-wing as Joe Biden can actually wade into this and do it, because his liberal bona fides and his history in the institution are so rock solid. And so it's certainly not something they're going to talk about in the campaign, but it's probably almost impossible. But this provides one small window and potential for him to pull that off, especially if he's got a divided Congress and he wants to do something really meaningful in a second term. We think that really is something that he could pull off, unlike anybody else.
I got one question.
Oh, yeah. With support from the Ukraine war waning, do you think Biden pulls away a little from them in terms of support as November looms? I think that I think that the way that the support for Ukraine, I think, is I don't think support for Ukraine is going to be a big loser for the Biden administration. I think concessions to Russia would look worse for the Biden administration than than status quo. Essentially, we think that they do end up getting the Ukraine funding with this budget. We think the budget deal, do they have a brief shutdown after this Friday? That's certainly possible, but we don't think shutdowns go long. We think that Speaker Johnson is going to hold tight and stick to the top line spending deal. Everybody makes a lot of noise about the border. You get grandstanding from the far right that don't go along with it, but you get a bipartisan agreement. And he survives it because the Republican caucus is just not up for another bruising, replace the speaker fight, and certainly not in an election year with this coming up. So we think that he manages to do the deal that would basically do the same deal that cost McCarthy his seat, but it doesn't cost him because because the political calculus is just too many in the negative column to have another fight over the speakership, and so we think that Ukraine funding gets done. We think that the Biden administration holds the status quo and doesn't really change anything. Maybe once the election is over, the Biden team begins to push for some sort of negotiation, some sort of negotiated solution. But for now, we've long thought that essentially from a geostrategic perspective, this is not this is a realpolitik kind of posture, but they won't tell you this, but Western and U.S. military communities, the longer the Eastern Ukraine is a meat grinder, the more men and material for Russia get ground up in that meat grinder, the better it is for the West. And to the extent that we can keep Ukraine from losing and keep Russia from making any significant ground up, and just keep feeding their men and material into the abyss, that's probably what they're going to do for the near term. Any progress with the SEC Stabilization Act this next year, or any more push for Gensler to be removed? What do you think?
I mean, nothing's getting passed, no matter other than this, funding bill, and then we're going to go to the election. So I don't see a path forward on that front, and you're not going to sack the the head of the SEC in an election year. So I think all of that stuff gets pushed off into 2025, and obviously, if Trump is the president, then it's a moot point.
Yeah, it'll be interesting. There was a sense that Gensler wanted Treasury, wanted the Treasury Secretary spot, and that the SEC chair was maybe a tryout for that. But I don't think that at this point that's very likely. Our expectation is that it's probably Lael Brainerd.
It's a done deal. That's why she went over to the White House. Yeah.
That's our expectation, and we think that a second Biden term would have Lael as the Treasury Secretary. Lael Brainerd is obviously, very well steeped in financial markets. She's going to be focused on righting the ship in the Treasury market. This is part of our out of the money option on entitlement reform. Like a team like Lael at Treasury, and you get essentially the Biden administration giving them top cover for this approach. It's a possibility, and someone as forceful and capable as Lael would be the kind of Treasury Secretary that could get that done. She was very well. When I was at Treasury, I didn't overlap with her at Treasury, but she was very well regarded and maybe feared as an effective institutional infighter. So she can really get things done, I've been told. Any other questions?
Yeah, I was gonna say I don't see any other questions, and we're kind of at that 35-minute mark. So I guess we'll.
Oh, let's see.
That's a good question.
Will Biden make any moves to the center in the election year? I think that's a great question. And what is a centrist? What kind of centrist maneuver would he put on the table? I think that the policy. I think that he's going to try to be try to be a centrist in terms of his overall posture. He's going to try to push the risks around the world, geopolitics, steady hand on the tiller, stick with the legacy, the infrastructure. They desperately want to talk about the Inflation Reduction Act and the money that's going to be going and that is going into some of these projects. And I just don't think that he has a particularly left-leaning agenda. I think that he's going to talk about, election integrity legislation, on women's rights and that sort of stuff. I don't think that he's going to be like, we got to jack up taxes on jack up taxes and all this stuff. He's probably going to, focus on sort of getting the rich to pay their fair share, or that sort of stuff. But it plays pretty well to the middle. We don't think he's going to run left.
Right. Because it is a good question, because, if Trump versus Biden, it's that kind of center-right vote that is up in the air. A lot of it's going to probably end up doing with polling and seeing where we are in, 4 or 5 months. But that is an important thing to watch, because that's probably the vote that decides who's president.
Yeah, I mean, one of the things about the Biden administration is he's really alienated the left.
Yeah.
Right? As much as the right hate him, the far left is absolutely disgusted about his posture toward Israel, which is a full-on support, hug Netanyahu, the whole kit and caboodle on that front. And the far left is not excited about that. And I don't think that he's going to change his policy in Israel to appreciably to try to bring them back into the fold. I think that he's going to run as the steady hand and stick with the program. Things are getting better, and look at the and his classic motif. Don't compare me to the almighty, compare me to the alternative. And there's just going to be a lot of the campaign is going to be spent, sort of looking over at the Trump campaign, like, you sure you want that? So. Any other questions?
All right. Well, it didn't look like anything else was coming through, so we'll go ahead and wrap it up.
It was all very, very, very good, and thank you all for taking the time and joining us.
Yeah, absolutely. We want to make sure that we thank Brendan and John for sharing their perspective. If you want to listen to the presentation again, it'll be emailed to you after the call with a research briefing recap. And if you're interested in Markets Policy Partners, their research offering, just let us know. Finally, mark your calendars for next month's CAPIS research briefing featuring Katie Stockton from Fairlead Strategies. The call will be on February 15th at 10 a.m. Central. Registration will be open and invitations will be sent out here in a few weeks. Thanks, guys, and thanks, everyone. Happy trading. Talk to you soon.
Stay warm.
Yeah, absolutely.